Hello, everyone. This is Noah and John. Happy New Year from the UrbanDigs team. This is going to be a special edition. We have a 2020 annual market Manhattan review. Johnny, let's get right to it. I don't want to waste any time. Supply came in at 7447. That looks like it's going down. Show me the chart.
Yep, still going down. I mean, I guess this is not the time of year people listing, so not a surprise there.
No, it is not. Let's go over to demand. It came in at pending sales, 3,070. It looks like it's going up. That is unexpected. Show me the chart.
It is unexpected. I mean, I suppose you could blame maybe some Acris delays with the holidays for sort of a steep increase here. But I mean, look, we're running, goodness sakes, we're close to 30% on a year-over-year basis in terms of pending sales. So people might not be listing, but they are buying.
Yeah, and in case you're counting at home, this is just, I mean, week after week of declining supply and rising deal volume. And at the end of the day, the supply pending sales balance is vastly shifted in real time in the field right now. It's completely different than what it was back in July and August on the reopen. So if you're in the field and you're looking for Manhattan real estate, you are just seeing a very different thing, a different animal than what has happened 3-4 months ago. Very interesting to see it unfold in real time. Let's go to the market ticker, Johnny. Even though it's the holidays, let's look at the weeklies. Supply came in at 77. You hit it right on the nail on the head. It's down big time. Show me the chart.
Yeah, again, supply is really not surprising. I mean, just not a lot of people in general list this time of year. You can look at the chart right here. You can see every year right around here it drops to its low. So even though it's low, I do expect this to start picking up once we start entering into January, and that's going to be a big question we're going to talk about later.
Right. I think usually the second or third week of January is when that listing volume starts to increase, and you'll see a steady increase as you go into February, March, and April. And we did not have an active season in 2020. There was no active season. There was no seasonality. We'll get to that in a second. Very, very important to note that this was no seasonality this year. Let's go to contract signed, Johnny. 1 week contract signed. It looks like there's no off season for contract signed. 187. We're down, but it looks good. Show me the chart.
No, it's very interesting. I mean, you look at the week over week, and it's just 2020 is just really was crushing 2019's butt. I mean, it was just the last month of contract signs on a weekly basis for 2020 have been outstanding compared to last year. So it's very interesting to see heading into 2021. Let's see if this momentum can continue.
It's incredible. And let's see. I hope it does. Now, Johnny, let's go to some really good stuff over here. Okay. We're going to go into some annual review. Annual review, meaning we're going to take all of the sales and all the listings in 2020 and combine it into a bucket and then compare it to other years, 2019, 2018, and go all the way back as far back as we can. Yeah. Now, this first chart is showing you contract signed by year. I mean, I think it's the most pure, rawest form of deal volume of demand from Manhattan real estate is how many contracts were signed, right? And we didn't have a full year. Let's be clear. I mean, we had a full year, but 3 months were shut down, and there you go. So this is showing you how many contracts were signed going back all the way back to 2007 and what 2020 did in relation to that. It's quite a chart. What do you see here, John?
No, it's interesting. And I think you hit the nail on the head. I mean, look, we're at 7,200 deals signed for 2020, and we're missing a quarter of the year. So if you were to sort of like pencil that in, where would that bar be? I mean, yes, it's obvious to say, hey, 2020 was a horrible year and it's much lower than 2019. Oh, let's forget about it, move on. But honestly, the last quarter of 2020 was a pretty phenomenal rebound. And I think these numbers hide that story.
That's true. I would say the majority of these deals have been in the last 3 or 4 months. It's quite interesting. Let's move on to the next chart. Excuse me, right there. I'm going to go on now to supply versus pending sales, Johnny. Supply versus pending sales. End of year number. December 31st. All right. Where were we this year? December 31st last year, December 31st 2 years ago. Where did supply end? Where did pending sales end? This is quite an interesting chart, and it may scratch some heads, okay? Supply is obviously the black bar. Pending sales is the red line. So you're measuring supply and demand in real time here. And when I look at this chart, a couple of things come to my mind. So I want to throw that out there. First off, supply is obviously at near record high levels in terms of how we're ending the year, right? Pending sales is at very high levels. If you go across here, and it may make people wonder, well, what's going on here, Johnny? And it's important to note that we're ending this year very strong, okay? Yeah. We're ending this year extremely strong, and this is not a normal year. So like when I look at 3,070, that's like what we usually hit in the middle of the year when we have the peak season in June or July and we see pending sales hit its peak. Usually in December, pending sales is already coming down. Okay. So when you're comparing this chart, this red line right over here, you're comparing this to pending sales December 31st last year, it's going to be low. What you should look at, okay, what you should look at is the spread. The spread between these two, and what that tells you, John, if you look over here in 2013, 2014, and 2015, those were very strong years. Very strong years. Low supply, decent to high pending sales relative. When you look at years like 2008 and 2009 and 2010, and then you look at these years of 2016, 17, and 18, this is when the market was declining. And you could see that these spreads were expanding. And so when I look at the spread right now, that's really where the weakness is showing.
Yeah, that's true. And you also have to bear in mind that, as you noted, this is basically what's happening at the year end. So, listen, if we were going to sort of add to the bar in the previous one by saying we're missing a quarter, we do have to lower this red line in this one because this is not a typical year end. So I do think the weakness is a little bit more exaggerated than this chart actually shows. But it's interesting to see that red line ticking up. I mean, it's really it's a new kind of phenomenon to see that line sort of head up. It's the first time we've seen a tick up since what, 2014?
Well, let's take another look. Let's take another look at that, Johnny. Let's take a look at pending sales. This is pure pending sales right over here. And I took the liberty of setting this up beforehand to show you exactly what you're saying, right? This is visualizing what John is saying. This is the summer peak. Pending sales usually has one peak every year. And that peak, if you look at, that's usually June. This is June, right? This is a June, July of every single year. And you could see it. So when you look at where were we in June, July this year, this is where we were at in June, July of this year for 2020. And this is how we're ending the year. So that's showing you, all right, we're having our active season at a later date.
Yeah. And I think what's interesting about this chart is if you just, simply look at the peak to trough on each of these ones, and you look at the 2020 peak to trough, that is a steeper and longer rise than pretty much most of these years, except for maybe 2012 to 13. From where you went to where you ended up. It's a bullish sign for New York City real estate. I'll just say that. I'll throw that out there.
Yeah, the worst could be behind us. That's what it looks like. The worst is behind us. So now let's shift out now. I want to go back to my annuals, John. Everyone likes to see listing discount discount by year. So let's take all the sales in 2020, okay? And all the sales last year, et cetera, same concept. And I want to see two numbers. What was the listing discount from original ask? What was the listing discount from the last ask? Original ask is in black and last ask is in red. Okay, this is extremely interesting because as you go across this, there's a couple things I'm seeing here. Number one, obviously we could see the trend up. All right, that is a weakening sign. Okay, number two, I could see the great financial crisis. I could see where we are now, and I could see clearly this is a totally different animal. Okay, we're not giving the discounts that you saw at the great financial crisis. We talked about that often. Okay, and finally, the discount from last ask versus the discount from original ask is about half on all of these. Take a look at this. Well, what do you see here, Johnny?
No, I think you're right. It seems like you basically get half the first time and then you get half the second time.
Right. So you're reducing your price and then the rest is negotiability, really. So it's an interesting way of looking at where we are now relative to, again, the last 13 years of history here, pure data. And to show you, people may be confused. Why is this COVID crisis not showing us these huge discounts? And the answer is that most of the deals were 2 million and under, John. And those discounts were just not at 15, 20%.
I know. There's a couple things I'd like to say. Number one, I would love to see this if we backed out the COVID trades. Not that there was a lot of them that would have contributed to this, but they do contribute. So I'd like to see this without that. I'd also like to see this broken down by price point because, as we know, when this market reopened, it was really that under 2 million market that sort of, jump started. And I also like to see this for Brooklyn because Brooklyn, as everyone knows, is just on fire. And we could actually be seeing some negative listing discounts on a year-over-year basis. That's just pure speculation, but just, from hearsay and just looking at the numbers, I get a sense that these would be drastically lower if you looked at the other borough.
Yeah, it's so local, all these different sectors right over here. It's really a good conversation to have, John. And let's just finish this off here with some price trends, all right? And I told everyone, we've been telling everyone for months, the price trends are going to be wacky. They're not going to show you what you think that you want to see here. It's not going to fit the narrative what we just went through. So let's just take a look at this. And again, this is annual. All right, guys, I'm taking all the sales, 2020, et cetera, et cetera. And here's what it looks like. Median sales price is in black. Median sales price is in black. Price per square foot is in red. I like to use price per square foot. It's more linear. It's smoother. But you know, when I look at a chart like this, I mean, there's a couple of things that come to mind. Number one, it's not real time. Okay, these are closed sales. They're lagging. Okay, and when I see a peak here in 2017, in reality, the peak was in 2015. Okay, you got to think about all the new developments that were closing late, et cetera, and that's normal for this market. But when I look at how much we're down, we're just not down that much, Johnny.
No, you're absolutely right, and that's, I think, one of the more interesting things that's happened in this market is when you look at where the prices are. Everyone is expecting, oh my God, 30% off, 20% off. It just didn't happen that way, and I think a lot of that has to do with the fact that buyers sort of on the lower end, the sub million, sub 2 million price point, returned somewhat quickly to the market in Manhattan, and it was only that upper echelon, the 4 million above luxury listings that are still sort of, you know, once you get above 10 million. It's a rarefied buyer pool to begin with, and you've probably had some issues in the last few months, despite the fact that the market's been up. But yeah, it's interesting to see.
I think anything 4 million plus new developments are still. I mean, everyone's seeing a pickup in activity, but those higher price points are just you don't have the liquidity coming back. And when we think of the market that was severely dislocated, John, severely dislocated and completely illiquid, no one was doing deals. Like, people forget that the sellers chose not to hit those bids en masse, right? So it's really interesting. Okay, let's end with some price cuts. All right, people want to know price cuts. This is actually only for 2020. We're not doing historical here. Okay, we'll do that in the future. But when we updated data, people asked us for updated data, and we have December now included. So this is including all the sales as of 5 minutes ago, before we started recording this. And here is the average price cut that sellers are going every single month. And I mean, it's just, you know, if you're a seller right here, May was the worst part of it. You know what I'm saying? November was the second worst part of it. We're starting to get a little better, but you're still in that 9.6% range in terms of price cuts. And sellers are always scratching their head in terms of, what do I need to lower my price to get a deal done? Well, this is just pure data, so it might help you.
Yeah, this is it. Let me just clarify. So when we look at this, we're basically looking at contract signs. We're saying, well, what was the original price and what's the last ask going into contract sign? And that's basically what the price was cut.
Right.
But yeah, you're right. It's interesting that November and December have kicked up since October. And I think that has to do with the fact that you saw more higher end listings closing and getting signed into contract then. So naturally, they're going to have, in generally, just have higher price cuts to begin with, simply because they have a wider range of uncertainty when it comes to figuring out where the buyers are. So I think that might have something to do with it. We could break this down by price point to look at it, but it's interesting stuff.
Yeah, and I mean, and if you're wondering what this with this right here, October 7.3%, this dip going down here, I would imagine this has something to do with the reopen and those deals that were signed at the reopen July, August, and September. Maybe they didn't have a lot of price cuts and they were signed, and that's what that's reflecting, is the initial wave of the reopen and those deals that were signed with all those new listings that were coming on.
Right. Interesting. Right.
So, I mean, you know, this data is overwhelming. I mean, we're here to help you guys. We're talking about this every week. But, John, I want to just take a step back. Okay, we got a couple of minutes, right? This is not a weekly report. This is an annual report. And I want to talk about some macro stuff, John.
Okay.
Looking ahead, what do you see going on in this market? Looking ahead, 2021. Give me some predictions.
Well, which market are you talking about, Noah?
Well, let's talk about Manhattan real estate, John.
Okay. Well, here's my thought on this is I think we've had really a groundswell of momentum coming into the new year. I do think we're going to see a sharp increase in listing activity once we get into January. I am a bit concerned that the contract sign numbers are going to start to dip because of the holidays and just because of the fact that there was a wave of buying. If that starts ebbing and supply starts coming on, we might start seeing the numbers sort of shift again, and that might spook people. But I do think that as we're heading into our first natural busy season, which will be the spring, once that starts rolling into high gear, hopefully February, March, that we might actually be on a bit more stable ground than we have been in the last 5 years or more.
Yeah.
That's what I think.
No, it's interesting to hear you tell it like that. I mean, look, I mean, we've been through 2020 was not, there was no seasonality to it. It was dislocated. It was completely erratic. It was just a one-off kind of thing, like a generational thing. So this year's obviously in terms of fear and uncertainty and risk is just going to be at a completely different level in terms of deal volume and what sellers are willing to offer for discounts. But I mean, we got some great momentum now. I don't think anyone saw that momentum coming. You got a stock market that's just at record highs. Put aside the fact that it's goosed with all Fed activity and central bank activity, which we'll talk about in a second. I think that continues. We got a fiscal package coming, Johnny. I think that's ultimately going to get passed. I think that will continue to goose assets. So I think Manhattan's along for the ride over there. I think the gap between the whole suburb trade and the whole dense urban trade is quickly shrinking. I don't have much data. But I think that the suburb reflation surge, I can't see that the rate of change continuing like it did over the last 8 months.
Yeah,
versus,
I think you're absolutely right. First of all, I think the city has a number of issues that's going to have to deal with on a macro level. You're right that the stimulus package is in. I mean, if you look at, part of it is that, co-ops now can apply for the PPP. So this is a good thing, I think, for the city. But when you talk about the suburbs, I think you're exactly right. And why do I think you're right? Because I think that what do buyers care about? They care about negotiation. Can you get that in the suburbs right now? Not necessarily. Can you get in the city? Certainly. They care about, what else do they care about? They care about negotiation. They care about choice. Do they have choice in the suburbs? Not really. Do they have choice in the city? Yes, they do. So, and they care about, if they could get a deal. And it's starting to shape up that the suburbs are less and less of a deal than they were a few years ago, whereas the city is becoming more and more of a deal. And I'm not saying it's a steal, but I'm simply saying that if you're a buyer right now, you've got choice and you've got negotiation and you've got, money is cheap. So you've got a lot of things in your favor that you didn't have before. And these are things that I think are going to continue on through the spring.
Right. And let's not forget that Manhattan still, I mean, we have a number of tentacles to this buyer pool in Manhattan that's interested in our product, our inventory, whether it's rentals or sales, that is not open and active yet. And we're talking about like foreign investors, we're talking about foreign businesses that are bringing people in. We're talking about a number of different things that are shut down. If you just dissect the demographics of the Manhattan buyer pool into tentacles, I mean, you got 3-4 tentacles that are not active right now. And what's going to happen over time in 2021 will bring this is you're going to have one tentacle come back online, and then you're going to have another one come back online. And we discussed this, and you're going to have new buyers finally there that weren't there before. So what you're seeing right now in our market, and you're seeing the deal volume that we're talking about, is really, I think, the local people that's getting in, the real buyers. It's not those foreigners, it's not those outsiders yet. Maybe they're trying to put money in and they're getting some bulk deals. They might be disappointed in the fact that they're not getting 15-20% off for a lot of good deals. It's just not happening. But you're going to see this happen in stages, and that's what 2021 will bring. But let's think about the negative. Let's just be unbiased here, John. There's some risks out there. There's some tailwinds. What are the biggest triggers that could impact our market in a negative way? Our market meaning real estate.
Well, I mean, listen, there's a second variant of COVID going around that's highly contagious. I think the mortality rates are similar, but the fact that it's more contagious has prompted more severe lockdowns in Europe as well as other places in the United States. So that's always a threat. It'd be great if we can get the vaccinations going in, but so that's out there. I think the equity markets are screaming higher, which is always a worry. When you see something go up that fast is a bit of a worry. I think the city itself has a number of issues that it has to deal with. I mean, we have, there's an ongoing issue in terms of how people are talking with each other about, is crime increasing in my part of the city? Is public transportation any good? Is it reliable? Can I use it? Is the city government going to continue functioning as well as it should because we have an election year? So I think there are a lot of macro uncertainties out there. But, these are, to me, these seem like big clunky things, which just sort of rattle around. And on the buy side, on the individual level, people do pay attention to it, but it's not something that it really affects people in a mass way like the COVID shutdowns did.
Yeah, and you know what? That's really interesting because some forces affect people in a mass way, and some forces don't. And people brought up the whole pied-à-terre tax thing. That pied-à-terre tax talk has been going on for years. We've been hearing about that. Even if that happens, I don't think that is going to be a big force relative to the forces that you just talked about, the deflationary forces. Those are overwhelming forces versus, say, a pied-à-terre tax. So that's one example of what we're talking about here. Good point. If I had to give my share, my thoughts to share, number one, my biggest concern is going to be the stock market. Now, I think we are in crazy times right now. Risk is completely mispriced. What the Fed and what they're doing is completely nuts. Okay. But you're not really going to see that until it all falls apart. So I think that the stock market right now is in its kind of final leg of a melt up craziness. And I do think the risks are high that there will be a substantial correction down there. I'm worried about that and how that affects our buyer psychology. Do people take a step back? Because let's not forget that this whole reflation that we've had in the stock market, John, and also Manhattan real estate, the stock market has reflated to record highs during this whole thing. So that probably has played a role in the uptrend of Manhattan real estate, giving confidence back that maybe we're out of the woods.
Yeah,
so I'm worried about that. I'm also worried about policy.
Yeah, no, I know. So let me
go ahead.
Sorry. I'm just going to step on your toes right there. But I think it's a great point. I think, when you look at the last major crisis we went through, 2009, that was a fiscal crisis. That was a financial crisis. And that, even though it was short-lived, I mean, you saw in the previous chart the spread between supply and pending. I mean, it brought the market to a halt. This was not necessarily. I mean, there is certainly some financial components to it, but the whole COVID crisis was something sort of outside. It included everybody, but it was not financially induced. It was not a panic in terms of like there's an entire sector of the economy that's going down the drain, that's dragging everything with it. It's just like this big macro thing we all have to deal with. And at the end of the day, people were like, well, okay, I'm still alive. I still believe in the city, and let's get some deals going. And it's an interesting point that I think that the financial ones are a lot more worrisome for the market than the sort of global macro ones. Like,
and we also have some local. I mean, I think local policies in New York City. We got a new election coming up, a new mayor coming in. Are we going to have those pro-business, pro-growth policies that we can have? Let's not forget that we have had a 5-year policy-driven slowdown. I'm not going to call it a bust or of any nature, but 2015 peak, 16, 17, 18, 19, before COVID, and people don't talk about this, we were just slowly, step-by-step declining from policy changes. That could change. And when that changes and that brings in investment and that brings in, it clarifies, it reduces risk, it brings more certainty in for investors, you'll be surprised at how that steamrolls and how the housing market reacts to something like that.
That's another great point. And I'll just follow up with that. I feel like if you look at the markets and you look at the COVID hit and you're looking at April, May, June, when everything was down, to me, if I'm an investor, that's my risk. That's as low as it can go. So I know what that is and I can start pricing that. So I think that now you can look at the market and you can sort of assess with much more clarity, well, what's the opportunity? And I think that's one of the things we're going to see in 2021 is a lot more recognition of opportunity in the market across all the spectrums.
John, inflation down the road, a problem, yes or no?
I'm going to say no on that. I would have said yes. I for a long time, I thought it was going to be a problem, but right now I'm going to say no. Okay. What do you mean down the road? You mean like 5-10 years? Or like next year? Next year, no. How about
that? I down the road, I meant 5-10. You know what? Honestly, next year, no, right? Deflation now. I think we're going to have something we haven't seen in a long time. In 40, 50 years, since the 70s, we're going to see inflation rising. And when I look at down the road if I'm an investor looking 5-7 years down the road, and I'm looking at where this market might be in 25, 27, I think inflation is going to be poking its head at that time, big time. And hard assets, real estate is a good hedge for inflation. So I think that 2021 is gonna be a tough year. I think we're going to have the side effects of this whole craziness that we've saw. Maybe the stock market might hurt us a little bit. Get past that. I think this market's got a roaring decade ahead.
Interesting. I think three quarters of the population is going to buy into Bitcoin. It's going to go to 1 million, then it's going to crash to 1,000, and that's going to be the reckoning.
And we're going to end it on that. Thank you so much for listening. By the way, if you liked the charts from today, you could find them right here on our weekly reports. These are unique charts that John and I are putting out weekly for our Pro Full subscribers. We also have our forum right over here that John and I are actively in. If you have questions, we have answers. Please do not hesitate. That is John Walkup. I am Noah Rosenblatt. We are from UrbanDigs, wishing you a happy and a healthy new year. And we'll catch you next time.